Well, ladies and gentlemen, welcome to a quick podcast. What I'm going to look at, I'm going to do two quick podcasts looking firstly at what content of a director's report in a limited company, and then I'm going to move on to look at the content of the auditor's report. There have been a lot of changes in about the last sort of 9 or 10 years. In the UK, it was originally driven by something called the Companies Act 2006, which included or made a requirement for companies to change the way they reported and make the reports more understandable for the shareholders. In the rest of the world, the International Accounting Standards Board drove through the similar changes. So there haven't been any changes really to the UK regulation. There have been some minor ones in 2013, but it was largely the Companies Act in the UK was already compliant with these changes that have been happening in the rest of the world. As you can see, a company is now trying to make the reports much more colourful, trying to encourage particularly small shareholders to read them. So here we've got an example from Coca-Cola, and here we've got an example of some information that's come through from Tesco's. And what you can see in here is the way they're trying to break down the information as well on the company. So not only have you got total information, you've also got information about different areas in which Tesco's operate. As I've said, the main driver for this in the UK, Companies Act 2006, the information I've taken in this part of the presentation comes straight from the Companies Act, but obviously I'm going to explain what it actually means. A director's report for financial year must include the name of anybody who's been a director in that company during the course of the year, and including any shares and debentures that held, including those that were sold or purchased during the year. This is a big and important change because what had happened in the past was directors were either selling shares in their company because they thought it was likely that in the future the value of the company would go down because they knew something about what was going to happen, or equally they might have been buying shares because they were aware of some positive news that was about to come out, and therefore they were going to be able to profit from it. You also include all the principal activities of the company, and this little bit here, what it also means, if you own over 50% of the shares, in fact actually over 25% of the shares in the company, that isn't the actual main operating company, you should also include what those subsidiary companies do. So for example, what I'm aware of is that Tesco's in the UK own a chain of garden centres, and that's information on the garden centres is also included in the final accounts. And finally, what it should also include is information on any dividends which the directors are recommending should be paid. Up until 2006, what limited companies used to do was actually put the dividends in as if they were going to be paid, so they'd actually be part of the income statement. And it was decided, I think quite rightly, that the rest of the world, by and large, actually put in as a recommendation because they said that the shareholders were the people who actually decided what to do with the profits and not the directors, and therefore what the directors were doing was recommending to them how much money should be given out to the shareholders and how much should be reinvested in the business. So obviously if the shareholders decide the directors aren't doing a good job, they've then got the right to say, well actually we don't want you to keep this money that's been earned with our money to reinvest in the business. We can get a better return somewhere else. The business review section, that's the sort of really big change. That's where all the big colourful bits have come in. And there should be any information on change in activities. Have you stopped trading in Japan? Have you opened a new series of shops in America? Or are you trying to open a mobile phone business in Africa? Significant changes in assets. So for example, this hasn't been uncommon in retail for retailers to try and fund expansion through basically selling the shops that they own and then using that money to invest in a greater number of rented shops. And is there any significant research and development? So what we're talking about there, particularly pharmaceutical companies, if you've invented a new cure for cancer, that's important, and it might be that it's going to have a significant income stream within 1 or 2 years to the business, and that might mean that shareholders will make a decision to actually buy more shares. Okay, it's supposed to be there, the review of the business, not only as a sales document, but it is also meant to be there to help the shareholders decide how the directors have performed. And so included in the business review is a requirement for it to be both fair, and that's something that the auditors now have to comment on. Is the business review realistic? And it should also contain information on risks and uncertainties facing a company. So for example, if you were a company that sells an awful lot of CDs, that might be a problem because online music sales are actually increasing significantly, and as online music sales increase, sadly that does mean that you're going to be selling, or you're going to be making fewer sales of CDs, and therefore that's a big risk to your business. And finally, okay, this really only affects listed companies, so companies that are bought and sold on the stock market. So that's somebody like Pepsi-Cola, Coca-Cola, Tesco's in the UK, Volkswagen in Germany. They have a few additional things that they also need to report on. You have to talk about trends that are going to affect future developments. So for example, what's happening to the age profile in the countries in which you operate. If you're a company that sells something that appeals to younger people, then quite clearly, if the population's aging, such as in Japan, Germany, to some extent the United States, then it is probable that your sales are going to decline as the profile of the country changes. It should also include information about environmental matters. So for example, companies now have to talk about their carbon footprint. What are they going to try to do to reduce the impact of global warming? And there should also be two other sections, one containing information about how they treat their employees. So for example, how do they treat disabled staff? How are they making it easier for disabled staff to apply? How are they making it easier for disabled staff to actually work in the business? Breakdown of wages in the company, and there should also be something on the health and safety of the company. So for example, this weekend I travelled down from Kuwait down to Dubai, and a large oil company called KOC, they got part of their annual report, which was actually in the airport concourse, and in that report it was talking about a big drive they're making at the moment to reduce lower back problems amongst their staff who are currently working on oil fields. And finally, information on social and community issues, and that includes information about any money given to charities and any money given to political parties. In the UK, they must report any political donations over £200, that's $300 or 100 Kuwait dinar. So that's not a large threshold at which they've got to report. So that concludes what goes into the director's report. It'd be useful if you went and had a quick look online, perhaps had a quick scan through one so you know what we're talking about, and I'll get back to you in a few minutes and I'll go over what goes into the auditor's report. Thank you.